and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman, that's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
If there is something that the Treasury Secretary has some authority over versus the Fed funds rate, is Treasury yields. And what we saw over the last couple of years is under the Biden administration, Treasury Secretary Yellen changing the way in which they refunded treasuries that put downward pressure on the 10-year. My bet is they actually have to issue more 10-year treasuries, which will be a difficult part of keeping that lid on the long end of the curve.
Yeah, I think the forecast is fine. I think basically right in line with street expectations for the most part in terms of revenue, guiding EPS ahead. I know there are some analysts who thought earnings could even be higher. I'm sure they're reinvesting a lot of this back into the business for pipeline opportunities, et cetera. But I think when you see the totality of the numbers, I thought they were fairly strong.
I think the expectations from investors is that this will not be a protracted period of tariffs. They may last a few weeks. This is what we heard from that. If that happened, Ford actually last night said they can handle a couple of weeks. They wouldn't have to have anything cross the borders for that period. So an interesting perspective that folks are not incorporating it in their base case, certainly, but some overall just general conservatism of the macro outlook, just not on tariffs.
We got an hour to go until the market closed. So let's take a look at the major averages here. We've got the Dow trading lower, and all three major averages kind of took a dip a little while ago. The Dow off 245 points or so, about 0.5%. The S&P off 0.1%, and the Nasdaq is in the red as well, off around 0.1%. So we'll see if we see more of a recovery here. Didn't see any headlines necessarily that were trigger for that sell-off, but of course, perhaps the market is a little bit nervous going into tomorrow's jobs report, and we got Amazon earnings after the close.
Yeah, I mean, you got a lot coming at you if you're an investor right now. You've got big tech earnings after the bell. We've heard a lot of big tech names already, but now here comes Amazon, which is interesting, Julie, because you had its big cloud giants, big cloud rivals. They reported and left investors disappointed, right? And so we've been asking folks, was that a yellow flag? Was that kind of a warning sign for maybe what you're going to hear from Amazon after the bell? We did hear some strategists, tech analysts say they did think, getting a little nervous about what that could mean. We're going to soon find out. And then to your point, of course, economic data too, big jobs report on deck tomorrow morning. So investors have a lot coming.
Well, they do have a lot coming. NVIDIA shares, by the way, in the meantime, have been recovering a little bit today. We're seeing them rise by about 2%, so that helping cushion perhaps some of the blow to the downside. Let's also look at the sectors within the S&P 500 to see how they're shaking out ahead of tomorrow's morning's report. Energy, big drag here today, off by 2.2%, and really outpacing any of the other declines from healthcare or utilities. We've got financials and consumer staples to the upside today. But again, not necessarily seeing any headlines. Since we looked at energy, let's look at oil prices. Why don't we, to see what's going on there, if there is some sort of underlying tension with the oil stocks. And indeed, we did see oil dip lower over the course of the day, but not a huge decline there as it approaches $70 a barrel.
We've talked to some oil strategists too. I mean, longtime veterans who really talked about how many cross currents are coming at them. And these are people who've been in the business a long time.
Like Rebecca Babin from RBC
Unusual,
we talked to
just
this
the
week.
amount of cross currents they're having to navigate right now.
I should say CIBC, not RBC for Rebecca. Anyway, Amazon, as we've been talking about, is reporting fourth quarter results after the closing bell. And that means Yahoo Finance tech editor Dan Howley is back in action. This is like his Super Bowl, except it's stretched over 2 weeks and he doesn't get any sleep. And Dan, what can you tell us about what to expect from Amazon?
Yeah, I just want it all to end. But for Amazon this quarter, what we're looking for is obviously what's going on with AWS and what that means for Amazon's AI capabilities as well as CapEx. So let's just go over some of the numbers real quick. Amazon is expected to post earnings per share of $1.50 on revenue of $187.3 billion. That would be an increase from last year of EPS of $1 and revenue of $169.9 billion. Amazon Web Services is expected to top out at $28.8 billion. That would be up from $24.2 billion last year, and the ad business is expected to hit $17.3 billion. But as you guys were discussing, this comes as Microsoft and Google both missed on cloud revenue during their respective reports. Microsoft had posted $40 billion in cloud revenue. Wall Street was looking for 41.1. Google posted 11.9 billion. Analysts were looking for 12.9. So it's not like there were huge misses, but they're misses nonetheless. And obviously that brings up concerns whether they're properly monetizing their AI offerings, whether there's enough demand. And on the phone calls for both companies, CEO Satya Nadella at Microsoft and CEO Sundar Pichai at Google both went to great lengths to explain that it's not that there's no demand, it's that there's so much demand they can't keep up. What does that mean? A lot more spending on CapEx. And so that's why Microsoft announced that they're going on a big spending blitz as well as Google. So we'll see what Amazon has to say. I believe last time they announced anything, it was in the Q3. They said they're going to spend $75 billion, or were spending $75 billion in 2024. We'll have to see what they say about 2025 now.
Dan, what about all things DeepSeek? Cheaper, open source model. Investors have been so focused on it and chewing over it, what it means for this company, that sector. What are some potential ramifications for Amazon?
Yeah, I mean, look, Amazon already offers DeepSeek and their models on their Bedrock platform, where they offer different AI services. And so I think for them, it's, do we have all the offerings that customers want? Are we ensuring that those are available? And that's basically, I think, what they have to rely on. Obviously, they're heavily invested in Anthropic, along with Google. Microsoft heavily invested in OpenAI. If there are more models that come out similar to DeepSeek, where they're relatively inexpensive to build and don't require as hardcore chips as something like OpenAI does, it could spell trouble in the future for something like Amazon. But for now, I think offering it to its customers is a big deal.
Dan, thank you. Well, with those Amazon fourth quarter earnings, we could see a milestone for Amazon's revenue. For the first time, it is poised to surpass that of Walmart on a quarterly basis. Now, I have been watching this for a long time, at least since the companies crossed in terms of their market cap all the way back in 2014. That is when Amazon's market capitalization first surpassed that of Walmart, at the same time that its revenue was still dwarfed by the, at the time, exclusively bricks and mortar retailers. Remember, this was sort of revolutionary at the time, that Amazon, which was really, investors were pricing in a lot more growth for the company, had become bigger than Walmart, the world's largest retailer. And it has taken all of this time for the revenue of Amazon to exceed the revenue of Walmart. At least that is what is expected. So looking at those expectations, just to compare the two, $187 billion is what's expected this quarter for Amazon, $180 billion for Walmart, which reports later this month. And it's worth noting, of course, that Amazon's revenue is not just retail. It is AWS, it's cloud business, it is ad services, for example. Walmart is also diversified to some extent, but still is mostly retail. I was also looking at profitability just on the same basis. And here, Amazon has been intermittently, on a quarterly basis, more profitable than Walmart. But again, it just speaks to how the market really values what it sees as growth and certain areas of growth and profitability, like, of course, AWS and the cloud business. When it comes to profitability this quarter, Amazon's profit expected to be much larger than that of Walmart at nearly $22 billion to Walmart's $5 billion. Now, I want to take a moment to just talk about the stock performance as well, because over the past year, Walmart shares have actually done better than Amazon, about double, in fact. They're up about 81%. Amazon shares up about 40%. If you go back further, a little bit of a not necessarily different story. If you go back 5 years, Walmart up 164% to 131%. If you go all the way back to when Amazon's market cap first exceeded that of Walmart, indeed, Amazon has outperformed by a wide margin, up more than 300%, but Walmart has still outperformed the S&P 500. So it's just been interesting over the years to watch these two retailers, as they have been at times in direct competition, but not always when it comes to some segments of their business. And then if you go all the way back to today and how they're setting up ahead of Amazon's earnings, as we looked at, Amazon up about 0.5%, Walmart little change, Josh.
All right, Julie. Big earnings after the bell. Stocks mixed ahead of the closing bell on Wall Street. That's as investors now assess earnings season so far. For more on the latest market moves, let's welcome in now Brent Schutte, Northwestern Mutual Wealth Management Company CIO. Brent, always good to see you. So I know, Brent, you're talking to your clients, and listen, you're stressing diversification, Brent, risk management. What does that actually mean, though, Brent, in terms of how you want to be positioned? Does that mean you're saying, Brent, listen, you got to move completely and totally towards defense right now, Brent? Is that the takeaway for viewers?
No, I don't think you need to move totally towards anything. That's where I think a lot of people are tempted to move totally towards those names that you just talked about in your opening segment. Look, if you think of the market the past couple of years, yes, the S&P 500 has been up by over 20%. That is something that has occurred in large caps only. And that has been driven by one of the names that you mentioned quite a bit in your opening, which is where the market is today. The top 7 names in the S&P 500, the top 10 names have done a lot of the heavy lifting. That also speaks to the risk moving forward. You mentioned the word DeepSeek, which on a Monday ago drove those larger names down quite a bit, but the equal weighted S&P 500, the ones that don't have that market cap or that overweight towards the Mag 7, actually did better. And so you mentioned risk management, you mentioned portfolio management opportunities. Look, if you invest only in the S&P 500 right now, 7 companies control 33% of what happens to your wealth in the future. That's not an area that I think anybody should be comfortable with. It certainly worked in the past, but I've seen it not work in the future. And that's where typically narrow markets lead to broader markets. And that's where we're positioned more so now. We're thinking more about how the market broadens out to include more names, to include more of the 500 names in the S&P 500 doing better, to include small and mid-cap stocks. And luckily, I think that's on the horizon. And so it's not a concentration in any one part. It's not to move the defensive. It's just making sure that you stay true to diversification, because at points in the cycle, diversification feels painful until it doesn't. And that's when it pays for itself, which at some point in the not too distant future, one of those events may occur.
So, Brent, diversification so that you are insulated against a slowdown or risks to earnings of those super large companies and that concentration, exposure to a potential broadening out. But does it also have a sort of defensive quality, if you will? And if so, what are you defending against? What are the potential risks that you're looking out for?
I think it depends upon your time horizon. Certainly, if you have a long time horizon, as you're taught, you can look through whatever happens in the next 1, 3, 5, or even 10 years. And that's where having all equities, I think, is something that's still appropriate for someone with a long time horizon, as long as they're diversified equities. Because if you think about the past, we've seen this movie before. We saw it in the late 1990s where large cap tech did incredibly well towards the end. And then it was essentially a sleepy asset class for 17 years. In the middle part of the decade, people convinced themselves that China, emerging markets, the Eurozone, for those that don't recall, were going to be the path forward. And that fell flat on its face. And so asset classes don't die, they just go to sleep for a while. That's why I recommend people staying diversified among equity classes if they're going to stay in equities longer term. If you need the money in the near term, there's really good news right now. The fixed income market offers yield, something that it hasn't done for a lot of years in the past. And so that's where we'd have a position if you need the money. And certainly we still do like commodities from the standpoint of the potential for inflation. That serves a bit of a smaller part of our portfolio. But when you put all this together, if you're building a portfolio, this gives you a little bit more of an all-weather type of portfolio, which I think is something that investors should think about as they think about their financial futures.
Brent, you mentioned DeepSeek. I just want to touch base on that one more time. This cheaper open source AI model out of China. There's some people, Brent, who really think it could represent some type of broader inflection point. I'm wondering if you agree with that. And as a long time just market observer, market watcher, market participant, Brent, do you look at DeepSeek and see any kind of historical parallels to other periods?
100%. And I've done this for 30 years now, which means I'm really old. It also means that I saw the late 1990s, which I think serves a lot of parallels to today. If you think about the late 1990s, we had economic cycle overtime, a fancy way of saying that economic cycle lasted for quite a bit longer than what it normally would, because you had Y2K spending and you also had internet spending. And in the beginning, that internet spending benefited the companies who were putting it in place. I know people like to draw parallels to Cisco. That is a parallel that I think applies today to some of those names that are bringing AI to life. What happened in the future was that AI moved from benefiting just those companies getting it in place early to more societal as it became something that was more integrated into our society, as it became cheaper to implement, and it benefited the companies, more broad companies, that used it to reach their consumers in a more cost-effective manner. And that's where I'm hopeful AI helps some of the companies that haven't done well the past couple of years. to enhance their productivity, to enhance their margins, and enhance their earnings. And that's where I think you'll see it move to being more of that type of a enabler in the future.
So, Brant, tell me, when you're broadening out, when you're trying to diversify, what kind of criteria do you think investors should be looking at right now?
I mean, for us, we like U.S. small, U.S. mid, and the broader equal weight S&P. Look, last year, only 28% or 29% of the companies in the S&P 500 actually outperformed the index. That was the second year in a row of sub 30% outperformance by any one individual member. To find similar periods, you have to go back to 1998, 1999, that time period I keep mentioning. Before that, 1982 and 1973. Those were all near to or at the end of an economic cycle. And at the end of an economic cycle, the economy gets narrow and the markets get narrow. What happened on the other side was it broadened back out. And that's where I think history is a good idea of what could happen in the future. And that's where I think small cap and mid cap apply the same way. They did better in the post and after that. And I think the equal weighted S&P or just the other 493 companies will do better in the future. I think that's one way to think about it, making sure you have exposure to those. Certainly we still like large caps. And then I know it's painful, but international markets, I think, still offer opportunities at current levels for those who want to have some sort of hedge against some of the risks that are out there. What happens to the dollar? What happens to our debt? Things of that nature.
Brent, thanks so much. Good to see you.
Thank you much.
We're just getting started here on market domination. Coming up, Honeywell is breaking up. The company announcing it's going to split into 3 independent companies. But is it the right move for the industrial conglomerate? What does it mean for investors? We'll get you all the details later in the hour. Plus, Friday's jobs report will include revisions for previous months that may cause some confusion for investors. I'm going to break down how to make sense of it all right on the other side. Stick around. Much more market domination still to come.
President Trump's back and forth trade policy has created uncertainty for investors still searching for clarity on the Fed's next move. But some on Wall Street think the labor market, not inflation, is the place to look for better clues on what could push the Fed to cut rates later this year. And joining us now is Yahoo Finance's Alexandra Canal. Allie.
Hey, Josh. Yeah, so we know the big story over the past week has been the impact of tariffs and how that could muddy the inflation picture. And to that point, the Fed has been very focused on inflation. That's part of its dual mandate of maintaining price stability with maximum employment. But with inflation expected to remain elevated in the short to medium term, especially with those tariff uncertainties, it got me thinking about the second part of that dual mandate, and that is the labor market. And to that end, it's very possible that the only way we could see Fed rate cuts this year is if the labor market quickly breaks down. Now, of course, that hasn't happened at this point. Last week, Fed Chair Powell said the labor picture is, quote, stable and broadly in balance, but there have been some cracks underneath the surface. And remember, the last time we saw a sharp uptick in the unemployment rate, what happened? The Fed cut rates by 50 basis points. So let's start with the initial jobless claims data that we got today. And I want to focus on continuing claims. This is the ongoing weekly unemployment benefits previously filed by workers. And continuing claims right here, they're just below 1.9 million. They're at their highest level since November 2021. So chances are, if you lost your job, you're having quite a hard time finding a new one. And that's because we're in this low hire, low fire environment, which Powell himself has acknowledged as a concern. And you can see that trend reflected in the latest JOLTS data. So this is the hiring rate and the quits rate. You can see the hiring rate, it's held steady at just around 3.4%. If you ignore the anomaly of 2020, that was during the pandemic, and focus on the highs that we saw in 2022 during the Great Resignation, that was around 4.6%. So you're seeing this deceleration there. So not a lot of companies are hiring workers. Same thing can be said on the quit side of the story. Not a lot of people are quitting and leaving their jobs. So all this to say that the future of the labor market, any weakening there, any uptick in the unemployment rate, that's going to capture the Fed's attention. They've already signaled that rates are restrictive as is. They don't want to, and they don't need to see any further softening in jobs to achieve that 2% inflation target. So there's a lot riding on the health of the labor side of this dual mandate as we continue to debate if and when the Fed will commit to rate cuts. Josh?
I'll take it, Allie. Thank you so much. Chicago Fed President Austin Goolsbee warned on Wednesday that ignoring the potential inflationary impact of tariffs would be a mistake, citing the COVID-19 pandemic experience where supply chain disruptions drove up inflation. Joining us now, Andrew Levin, former Federal Reserve Board Special Advisor and Dartmouth College economics professor. Andrew, it's always great to see you. Obviously, the Fed has a lot to consider right now, and D.C. is just part of it. I actually want to start with the jobs part of the picture here because we're coming up on Jobs Day. And so I guess I would start with how concerned you are that there is a potential for any kind of deterioration in the jobs picture, or do you think that's sort of a less likely pressure for the Fed?
Yeah, I think that the good news is that the jobless claims that came out this morning, totally normal levels. The quits, the openings, job openings are pretty much at normal levels as a percentage of the labor market. The good news actually yesterday was the ADP payroll report, actually pretty strong. So there's some upside risk tomorrow that the overall employment report could be strong, for the last 4 weeks. So I don't feel too much uneasy about that. My concerns really are that inflation's running well above the Fed's target. And the question is kind of what's the Fed prepared to do to make sure that they have the first part of their mandate, which is price stability? How do they make sure that inflation comes back down to the target level?
Before we touch on inflation, just one more question, Andrew, on the jobs picture. Beyond just, with the print we get tomorrow morning, I'm curious how you think about that, our labor market evolving over 2025. Or, Andrew, at this point, is that actually too hard to say until we have greater clarity about immigration policy?
Yeah, I mean, there are obviously some policy adjustments, but I don't see the major policy adjustments the administration's going to make as likely to have any immediate effects on the labor market one way or the other. And so probably things will start to be a little more clear in a few weeks. The administration really got off to a very brisk start and making lots of things and announcing things and considering things. So it's a kind of flurry that we will see past and then be able to get a better idea looking forward.
And what are you going to be watching to get clarity on all of that, Andrew? Because to your point, I mean, we've got the deportations that are happening. We've got we still don't know what's happening with tariffs exactly, right? We know that they've been imposed on China. We don't know if they will end up being imposed elsewhere. And then there's the Doge rampage through the government. I don't know if that's going to have any sort of economic effects, but where are you watching for signs of potential effects?
I think, well, let's start with tariff because I think that's a pretty well-defined question. And actually, there's a great new report from the Boston Fed just out today. Encourage people to take a look at it. One really important point here is that China is a really tiny fraction of the imports that we have from China of consumer goods. It's just 1% of total U.S. Consumer spending. And you put a 10% tariff on that, you're talking about a 0.1% change in the level of prices. And even that 0.1% change in the price index would be if there's no substitution to any other countries or to U.S. sources for some of those products, which I'm assuming there would be. So that in and of itself is just not going to really be a meaningful change in the U.S. level of inflation. Now, the questions for Canada and Mexico loom larger, but I think our hope now certainly is that negotiations the next few weeks will resolve those uncertainties. It's clear the administration's prepared to, make serious threats, but those are part of a negotiation process that hopefully reaches a good outcome for all sides. So we're not really yet in the middle of a trade war, and if we did, of course, that could be a much bigger problem. But just starting with 10% tariffs on China probably won't be noticed by many consumers.
And Andrew, when it comes to the Federal Reserve and how it is modeling and analyzing all of these impacts, how does even one go about doing? I mean, it's difficult to do, right? So, what do you think they're going to be watching? How do you think they're going to do when it comes to trying to assess all of this?
Well, Chair Powell actually pointed out one indicator a couple of years ago that I think they keep coming back to. You can see some references to it in the minutes of their December meeting, and the next minutes will come out in a couple more weeks. We'll see. But that's looking at the service sector, what economists call sticky prices, the prices that aren't adjusted so often. And those prices, sticky prices right now are running about a percentage point, maybe 1.5 percentage above where they were before the pandemic. And that's a problem for the Federal Reserve because it means that getting all the way back toward their target is not necessarily going to be so easy. They may be facing some tough choices ahead. That might mean holding rates where they are, having a moderately tight policy for quite a while to come. I think in medical terms, it's like you have a chronic illness and you want to make sure that the patient gets back to full health. And allowing inflation to level off at 3 or 4% is not really good for the long run health of the U.S. economy. The Fed has to make sure that it comes all the way back to the target.
Andrew, what did you make? I'm just curious when you saw Scott Bessent, our new Treasury Secretary, his comments to Bloomberg said the Trump administration's focus with regard to bringing down borrowing costs is 10-year Treasury yields rather, he said, than the Federal Reserve's benchmark short-term interest rate. He and I are focused on the 10-year Treasury, Bessent said. He's not calling for the Fed to lower rates. I'm sure you saw that, Andrew. Just curious to get your response to it.
Yeah, I think I was really impressed. The White House understands that people don't like inflation. They understand that clearly. That was a big part of what happened this past year in what voters were expressing. They hate inflation. People hate it when the cost of living goes up and their wages and salaries and can't keep up. And I think this administration and this Congress understand that they need to do everything all the way across the board to help make sure that the cost of living stays manageable and help ordinary families to be able to keep up the cost of living. And so I think you hear that from what the Treasury Secretary was saying, that the administration's going to make efforts, but they're looking for the Fed to carry out its mandate. As your colleague said a few minutes ago, the mandate is price stability and maximum employment, both of those things together. And so that means it's critical. We're not at price stability right now. Inflation's almost double where it should be, according to some of these measures. And the Fed really needs to keep its eye on that, and it needs to carry that out. And it's great that the Treasury Secretary emphasized that the Fed should take that responsibility very seriously.
Andrew, thank you. Appreciate it. The January jobs report just around the corner, except it is not just the usual month-to-month data in Spotlight. Economists will also be watching labor market revisions for previous months. What do those revisions entail? It's a little complicated, so I'm going to try and walk you through what you should be watching for tomorrow morning when the numbers come out. First of all, let's talk about the composition of the regular monthly jobs report. What do we get? It's comprised of two different surveys. One called Current Employment Statistics, also referred to as the Establishment Survey. That surveys companies, and that results in things like the non-farm payrolls number. So that's one part of it. The other part of it is the Current Population Survey, also called the Household Survey, which, as the name would indicate, they call households, they call regular people and talk to them about whether they have a job. That results in statistics including the unemployment rate, among others. So those are the two big reports. So what gets revised here and why did they get revised? Well, the data that they draw from to do the regular revisions that we get every month are from unemployment claims and insurance claims. But then you get something called the Quarterly Census of Employment and Wages. That's based on tax records, and that is more comprehensive, but it comes later. So that's one of the reasons behind the revisions. Something else that the Bureau of Labor Statistics within the Labor Department does is called the birth-death model. It doesn't have to do with births and deaths of people. It has to do with births and deaths of businesses, as they try to factor in business creation and businesses closing down and the effect that that has and adjustments to the jobs market. And then finally, the updated Census Bureau population numbers. As we know, the Census Bureau does its best to try to come up with accurate counts of the U.S. population, but over time, they get more information, they get more data, and they try to update those numbers. So that's where all of these updates come from, and they come to different parts of the report. So the first two here will affect that establishment survey, the non-farm payrolls number, and then the latter here would have more of an effect on the household survey, the unemployment rate. So what effect is expected? We got a preliminary estimate for the 12 months of March 2023 through March 2024. We learned that in August. And it was a large erasure, the largest, or a large adjustment, I should say, the largest adjustment going back to 2009, 818,000 jobs lower than we originally thought. And most economists say it was still a robust number, but it was much lower than previously thought. Now economists say what we're going to hear tomorrow won't be quite as negative as that initial assessment. It should take the non-farm payrolls down, again, over a 12-month period by 600,000 to 700,000. We may see an additional adjustment down, specifically related to that birth-death model that I mentioned and changes to that. And then finally, there's the unemployment rate. 4.1% is where we currently stand here. And most economists say we will not see any significant revision or change to that. Why? Well, as we know, one of the things that has affected the unemployment rate and the overall employment picture over the past several years has been many immigrants, some of them illegally in the United States, who have been working and affecting these numbers, but who have not been accurately counted by the census. Now that could change, but it will change both the numerator and the denominator, both parts of this ratio, the unemployment rate, equally or roughly equally, and therefore not much change expected to the unemployment rate. So hopefully that gives a little bit of a primer on how folks should read what is looking to be an unusual revisions to the jobs report and what we'll get on Friday morning.
All right, could be a big morning to look forward to, Julie. Thank you for that. Appreciate it. Coming up, a bill to ban DeepSeek from government devices is coming, and we've got the details on the other side. Stick around. Much more market domination still to come.
Industrial conglomerate Honeywell is splitting up. The company announcing it'll break up into 3 independent companies, pursuing a full separation of automation, aerospace technologies, and advanced materials. And this comes not long after CEO Vimal Kapur told Yahoo Finance at the World Economic Forum about its market perception, as the company in recent years has not lived up to what he said was its historic growth.
If your results keep coming, I don't think market cares much about your conglomerate or not. And there are many companies or peers who also have multiple businesses, but their performance have been top quartile. So I think the discussion becomes more visible when your performance is more in the median.
Here with more on what's ahead for Honeywell, we've got RBC Capital Markets Managing Director Dean Dray. So Dean, as Kapur alluded to there, if everything was going gangbusters, this wouldn't be something that the company would be considering. But do you think it will indeed unlock value to have the company in 3 different pieces?
Well, you make a good point. If the stock was doing well, that really wouldn't come up as an issue, but it has languished its peers pretty significantly. And what else is interesting is Honeywell was the last outlier in a trend that's gone on for more than 5 years. We call it the urge to demerge. And there have been well-publicized successes, GE, United Technologies, in basically breaking up, and very successfully. So Honeywell was the lone holdout, and that's been resolved as of today.
The CEO, Dean, Vimal Kapur, do we know where is he going to be working? What's going to be his job? Has he explained that yet?
No, in fact, there's still a lot of details still to be shared. For example, they don't know yet if they're going to be spinning out the aerospace business and have automation be RemainCo or the other way around. If I had to guess, I think Vimmel will stay with the automation piece, but we'll see how this plays out. We're talking about 12 to 18 months before we'll get close to the spin out time.
When you talk about the urge to demerge, I guess that, General Electric has been sort of the poster child for that. In your view, is that a success? I mean, if you look at sort of research, the jury's sort of out in general on whether splitting up in the long term, a couple of years out from the spinoff, actually returns more value to shareholders. Is GE sort of a test case that it can work?
Yeah, it's not just GE, but we've also seen United Technologies go down this path. And you're right, you can have a longer term view and question. I think something like 20% of the spin outs actually end up getting acquired. So it gets harder to track how that all works out. But I saw a statistic that said from the time of GE, when Larry Culp joined, from the time today where you've got the three spins, collectively 4x value's been created. So it's hard to argue with that success.
Dean, why did Honeywell make this decision now? I mean, haven't activists made kind of similar calls before here? Didn't Third Point, raise similar ideas years ago?
Yeah, that's a great point. There have been some activists that have made passes at Honeywell. Nothing came out of it. And Honeywell was insistent that their model worked and that they could manage their way and be their own activist. And we watched this very carefully. And it wasn't until Elliott stepped in and said, here's the way you can unlock value. And it's not in the sum of the parts. It's how will the independent companies trade, again, based upon the success of of GE United Technologies. So that was the winning hand. And as Julie pointed out, when the stock languishes, the board is far more interested in making a change.
So does this tell us with Honeywell that the age of the conglomerate is definitively over? Was it over already? And then Honeywell's kind of late to the game? What do you think?
Yeah, Honeywell was absolutely late to the game. The conglomerate it's really pejorative now because it implies that you have businesses that have been put together without an underlying strategy. The preferred term is multi-industry, but even then, specialization, simplification, focused portfolio, that's what the market wants. I think longer term, you will get back into an M&A consolidation cycle. It won't look like the conglomerates of the 70s, but you will see companies making acquisitions in close adjacencies, and that will be the new modern version of the multi-industry sector.
Dean, on Honeywell, can I just ask you about the forecast for this year too? Adjusted earnings between 1010 and 1050, that missed consensus. It looks, Dean, like organic sales growth, free cash flow guidance, that also missed consensus. What's going on there?
Yeah, Josh, you nailed it. Everyone got excited about, hey, now we have the official announcement the breakup is happening, and it coincided with their earnings release. The release was actually fine from an operating results, but there was just disappointment across the board when everyone looked at the forward guidance, both first quarter 25 and for the year. For the year, it was 6% below consensus. At the midpoint, and for the first quarter, 10% below consensus. So it's hard to get excited about a breakup. You typically see companies do this from a position of strength, not where they've given such tepid guide, and that's the reason you saw the stock reverse, and it's down 5% and change.
Dean, really helpful perspective on all of this. Appreciate it.
Great to be with you.
U.S. lawmakers are moving to ban China's DeepSeek AI app from government devices. Analysis from Security found that the app could send user information to a Chinese-owned company banned from operating in the U.S. For more, we're bringing in Ivan Serini, CEO of Security. Ivan, thank you so much for being here. This is really interesting. Tell us what you found when it came to DeepSeek's models and the sort of backdoor, if you will.
Yeah, thanks for having me. And that's a very important question. So here's what we found is The DeepSeek website, the DeepSeek's chatbot that you can access on the website has instructions embedded into its software that is capable to send user information, especially sign up when you're signing up or when you're logging in, directly to servers that are owned by China Mobile, which is owned by the Chinese government. And that is something we've never seen before. And this is actually the first direct evidence and the link between technology companies and state-owned enterprises in China.
And what would be the risk there, Ivan? What kind of information could get sent to China Mobile?
Yeah, that's a really important point, because based on the technologies that we found on DeepSeek's website, they have, first of all, they have something called digital fingerprinting technology, which creates a unique fingerprint for every user. So if you're logging into that site, you will get digitally fingerprinted. And if you visit other websites, they will be able to track you. That's first of all. Second, what we found is they are obviously collecting the user information, everything that you're typing into the DeepSeek's chat bot, or uploading, and any other information you're uploading and providing to it. And thirdly, if you combine all of that with the pixel tracking technologies that are also present there, that means that everything that you provide into it, plus your digital fingerprint and your identity, they will be able to track you and tie your personal information to the queries that you submit, which is the first time we've ever seen being so personalized. And also they're able to collect your real-time information.
So, Ivan, that's quite a lot. And when we're talking about on government devices, if people are using DeepSeek, what do we know historically about how Chinese companies and even potentially the Chinese Communist Party has used that kind of information that it has gleaned from devices or through apps, et cetera?
Yeah, definitely what we've seen, because that's what our expertise is in identifying what kind of tracking technologies are embedded. And when it comes to especially state-owned devices like that are proposed to be banned, where the bill is proposing to ban use of DeepSeek apps on the state-owned devices, the risks that the bill will prevent or can prevent is potentially very sensitive information that government employees could be exposing it to DeepSeek and to other tracking technologies that are embedded into DeepSeek. So it's not just personal privacy risks, but also definitely there's a possibility to national security risks.
So Ivan, the app has hidden code that could send user login information to China Mobile. Do we have any evidence, Ivan, that has actually happened? Would we even be able to tell, Ivan, if it did happen?
Yeah, that's an important kind of clarification. So we're definitely seeing with 100% certainty, and this was independently verified, that there is information and some user information, behavior of information is being sent directly to China through Baidu tracker and pixels and other tracking technologies. We did not see direct evidence of information being sent to China mobile servers yet. That could be explained by various factors, whether maybe it could be triggered only for certain profiles, for users with certain digital fingerprint or other reasons. So we didn't see direct evidence information going to China mobile yet, but we've seen information going to various other servers in China.
Ivan, really interesting stuff. Helpful to know what could potentially be going on here. Thank you so much for joining us.
Thank you for having me.
Coming up, we're counting down to the closing bell and getting you set for the latest earnings results from Amazon. Buckle up. Stay tuned. More market domination still to come. Now time for some of today's trending tickers sponsored by Tasty Trade. First up, we got Philip Morris International. That stock jumping after a fourth quarter beat on both revenue and earnings. Philip Morris cited growth in its IQOS, its inhalable smoke-free product, as well as Zyn nicotine pouches. They won FDA authorization in 2024. The smoke-free portion of the company accounted for 40% of its total business. It's really all about the Zyn for the company, which are just apparently a big craze.
Zyn nicotine pouches, so they contain nicotine, but not tobacco, right? Sales rose 25% last year. So good, the company is building a new manufacturing facility in Colorado to just meet the demand. Put some numbers on it. Expects U.S. nicotine pouch shipments between 780 and 820 million cans next year. That would be growth of between 34 and 41%. They love Zyn.
I got a question
People
for you.
love Zyn.
If there's nicotine but no tobacco, does it cause gum and tongue cancer and all that fun stuff?
I can't.
I don't know either.
It's above my pay grade. I don't know. But apparently it feels good to a lot of people. The smoke-free business, by the way, which includes Zyn, represents about 40% of total net revenue at this point. That stock has been a winner. If you're in that, you're happy. You're up nearly 60% over the past 12 months. Zyn.
Yay.
You know, I'll bring in some tomorrow for the show for us. We'll try it. We'll see what happens.
I'd rather you bring in some products from the next trending ticker, please.
Okay. Our next trending ticker that Julie's referring to, I get it. Ralph Lauren, of course. That stock hitting a new record high today thanks to a Q3 earnings beat. This one's climbing. Q3 results beat. It boosts its annual forecasts for revenue growth and margin expansion, noting it's clearly resonating with consumers. And other premium luxury brands, by the way, because we've talked about this, LVMH, Versace, Gucci, they say maybe not reporting the same kind of results.
Yeah, and one analyst over at BNP Paribas talked about all regions outperforming, but the biggest surprise was North American wholesale, up 6% after what the analyst said has been a multi-year reset. The analyst there also, by the way, says Ralph Lauren's his top pick in the apparel space in recent years and continues to be in 2025.
Stock's up 90%.
Wow, who knew?
Over the past, who knew? Who knew?
All right, better than Zyn. All right, let's talk about Bristol Myers, please. Those shares lower Thursday despite better than expected earnings and revenue in the fourth quarter. The company's full year revenue guidance did come in below street expectations. Biopharmaceutical company CEO pointed to its new schizophrenia drug, Cobenfy, as a new growth driver for the rest of 2025. It's a new class of schizophrenia drug. There is a lot of excitement about that drug, but perhaps nothing new necessarily on the in the report on that specifically. You know, the story with Bristol Myers is like the story with a lot of these big pharma companies. They're going to be seeing competition, generic competition for some of their biggest drugs.
Yeah, the CEO talked about that in an interview, said competition from cheaper generics. They're coming for some key products, underappreciated by the street. Did say they're escalating cost cuts, plans to eliminate about $2 billion, it looks like, of spending by the end of 27.
Yeah, big risk.
While we're wrapping up today's market domination, don't go anywhere. We've got you covered all the action following the closing bell, including the latest earnings report from Amazon, as well as Pinterest, Affirm, and many more. Stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street, and now it's Market Domination Overtime, sponsored by Tasty Trade. We are joined by Jared Blickry to get you up to speed on the action from today's trade. I'm going to start with where the major averages ended the day. Now, an hour ago when we spoke, we had seen the major averages take a little bit of a mid-afternoon dip, if you will. They have mostly recovered, although the Dow finishing in the red, down about 126 points, 0.25%. The S&P 500 up by 0.4%, and the Nasdaq up by 0.5%. A lot that the market is digesting between earnings, awaiting Amazon earnings, and anticipating the jobs report tomorrow. So a mixed picture when all was said and done. Jared's got more details on today's action. Hi, Jared.
Yes, you got to go to some of the individual company names for the excitement. It was a mixed market today. I'm going to skip ahead because the bond market was pretty quiet as well. I'm going to skip ahead to the sector action. 3 in the red, led down by energy, also seeing healthcare and utilities down as well. So maybe a little bit of a defensive setup, or at least to when you consider the downside there. But financials taking the top spot, and this is also the first record close of February. And here's a one-year chart of financials. Just took out that January 30th high right there. And you can see it was putting in a little bit of a double top. Some people were calling that way too early, but we have rocketed above that. And then we also have staples, communication services, industrials, and consumer discretionary rounding out the top row. And some interesting things, some developments within the mega caps here. And we're looking at the Nasdaq 100. NVIDIA, nice 3.08% up day there. Meta, this is 14 days in a row. This is a one-year chart. I'll dial it down to a 2-month, but almost all of this movement right here has been an up day, also closing at another record. And as far as records go, I'm going to show you the Dow here. We got a number of them in this lineup too. We got JP Morgan, Walmart, and Goldman Sachs all closing at records here. Guys?
Thank you, Jared. We've got those Amazon earnings just coming out here. The share's down a quick 6%. 2 things I want to highlight in particular. The worst fears about the cloud revenue, well, they've been realized to some extent. AWS, Amazon Web Services sales, $28.79 billion, narrowly missing the $28.82 billion that analysts had anticipated. So that was one of the areas of focus. The other, of course, the forecast. First quarter net sales going to be $151 to $155.5 billion. Analysts had been looking for $158.6 billion. So obviously that is quite a gap there for Amazon. Now, all of this said, some of the other metrics look pretty good. Earnings per share in the first quarter at $1.86. That is 36 cents above what analysts had been anticipating. The physical stores, I should say, the numbers there beat estimates, and physical stores have been sort of a weaker spot for the company as of late, so that's something to look at. But the company does say currency was part of the effect here. The forecast includes the impact of $2.1 billion from foreign exchange rates, so that could be a part of the issue here and what happened. The company did say also that it saw a first quarter 2024 impact from leap year that actually added $1.5 billion in net sales. So if that leap year effect added net sales, unclear why we're seeing what looks like a miss in that first quarter sales forecast. So that's what we've got so far here. Looking at the company, I should say in the fourth quarter, Josh, operating margin also beat estimates at 11.3%. So some of the metrics were better, but if you look at that guidance, that's really where we're seeing the disappointment.
Yeah, I mean, to your point, Q4 operating margins better than expected. Q4 operating income is better than expected, 21.2 versus 18.84. But the focus here, as you know, was on AWS net sales, Q4 AWS net sales, $28.79 billion. Street was at $28.82 billion. Obviously, you had other cloud giants, Microsoft, Alphabet, they had reported and disappointed. So all eyes were on AWS and what's ahead. And then, of course, we're turning to the forecast, Julie, ahead. And that's disappointing as well, which explains why we're down in the red very quickly in after hours.
Yeah, and this really leads to questions about what is going on in the cloud businesses of these companies, right? Because we've now got 3 for 3 or 0 for 3, I guess, in terms of the cloud, the hyperscalers beating estimates in the cloud business, missing estimates in the cloud business, I should say. So there was some talk that they couldn't meet demand. They didn't have the capacity to meet demand. But at a certain point, is that the problem for all of them? Is it a demand problem at a certain point? So I think that, we're going to have to get more information from the call to see if we can get some more color on all of that.
Yeah, the stock had a very strong run as well. I mean, it was up about 40% over the past 12 months heading into this print. It looks like we're off the lows right here, Julie. We're now down about 2.5%. So, but to your point, you'll be looking for a lot more color and commentary on the call about the cloud business and about that forecast.
Yeah, I'm looking at the statement now to try and figure out if we got a little more color there. Andy Jassy, President and CEO, pointing out that the holiday shopping season was the most successful yet for Amazon. He says, when we look back on this quarter several years from now, I suspect what we'll most remember is, he said, the remarkable innovation delivered across all of our businesses. So trying to sort of, I guess, put that AWS in perspective. He says in terms of innovation, AWS, where we introduced the new Trainium 2 AI chip, was a highlight, as well as their foundation models that they've been doing in various parts of their business. So indeed, we'll see if with the benefit of hindsight, if this quarter doesn't look as the market is treating it at the moment, or maybe it won't even look like that tomorrow, the way that the market sometimes works. But for more on Amazon's fourth quarter, let's get a Citizens JMP equity research analyst, Nick Jones. Nick, what's your impression of this quarter, and particularly that AWS miss now following on the heels of its peers?
Yeah, I think there's some investors were holding out hope that maybe Amazon was gaining more share than some of the competitors. But in a lot of the conversations I had leading up to the quarter, I think there was a fair amount of folks who were expecting the growth to not be as strong given what Microsoft reported and what Google reported. I also really think that the stock reaction is likely more driven on the operating income guidance, more so than the AWS growth number. That's kind of how the narrative has been shifting over the last several quarters. So I think looking into the quarter, into the guidance, what some folks may be missing is we are lapping a leap year, right? So there's one less day this year versus last year. Last year, Easter was also in 1Q. This year, it's going to be in 2Q. So there's some moving pieces that could actually influence some of the retail business, the number of days in the quarter to generate revenue, that we'll look for some more clarity on the call.
Yeah, and Nick, on your point about operating income, so Q1 operating income, they're guiding for between 14 to 18 billion. The street was closer to 18.24 billion. Any ideas? Then obviously on the call, Nick, that'll be a focus. But any ideas? Some of the puts and takes that might have been at play there.
Yeah, I mean, look, FX has been a focus for a lot of folks. Kind of heading into the quarter, into the guidance. They've recently had to start monitoring products for recalls. That likely increased costs a little bit. They potentially are rejiggering their logistics as they pull back a little bit from UPS, which we heard a little bit earlier this week, last week. So I think there's a lot of kind of moving pieces here that we're going to need more color on for operating income inputs.
What's your number one question on the call for the company?
The number one question, I think, is cloud demand and how much demand is there for AI, right? We saw kind of the impact from DeepSeek over the last week. There's a lot of focus on, is this going to be a lot cheaper than we originally thought or not? Most of the tech majors are saying we still need to spend a lot of money in CapEx to build for future demand. I think that's kind of the key focus. And then operating income. I think this is a operating income story now, more so than AWS growth. I think folks know cloud migrations are going to go on for many, many years. AI is going to be around for a long time. We're in extremely early days. So I think really understanding the cost structure and some of the puts and takes on the 1Q guide, as I alluded to before, FX, leap year, lapping a leap year, a shift in Easter by 3 weeks from 1Q to 2Q. Things like that I think are going to be the focus.
Nick, how much do you want them to spend this year, right? I think they said they were spending $75 billion last year in CapEx. We know what their competitors are spending. What's a good number? Or is it just kind of the higher the better?
Yeah, so we're above consensus. We're at $90 billion in CapEx for 25. I think that might even be conservative. I think higher the better. We're in very, very early days for AI, and there's going to be a lot of compute. There's going to be a lot of distillation. No one really knows what to do with this stuff yet in terms of a consumer-facing product or even an enterprise-facing product to scale. So I think more the better. If you underspend now, you risk losing share later.
Nick, you mentioned DeepSeek, that cheaper open source model. How do you think about what that means for Amazon's business, potentially looking ahead?
I think it's probably encouraging, right? We got to see a Chinese company essentially distill other available models down to something that's a lot more efficient. I think that's probably going to trigger a lot of spend for many of their customers saying, wait a second, we can distill this and get the compute down to something that's affordable. So I think net, this is a positive for Amazon and the entire AI space.
Nick Jones, thank you so much today for joining the show. Appreciate it. Pinterest earnings just crossing the wire, and the stock is soaring here. It's all about first quarter guidance. Let's get you those numbers. Q4 revenue on adjusted EPS, 56 cents. The street is 65 cents, Julie. Revenue, Q4, 1.15 billion. The street is at 1.14 billion. Looks like Q4 monthly active users, 553. The estimate was closer to 547.2, but then you look at that guidance. Q1 revenue between 837 and 852 million. The street was closer to 835. That stock ripping here after hours.
Yeah, indeed, up by 21% here. I'm looking at the statement. Bill Reddy, the CEO of Pinterest, calling 2024 a banner year. This was the first billion-dollar revenue quarter that the company saw in the fourth quarter here. He says the strategy is paying off. People are coming to Pinterest more often. The platform has never been more actionable. And as he calls it, our lower funnel focus is driving results for users and advertisers. So, sort of taking a victory lap there as we see those numbers really come out ahead of what analysts had been anticipating.
One other question I know some analysts were asking, Julie, was whether all the TikTok uncertainty, was it in some ways, maybe making that Pinterest platform any more attractive to marketers?
I don't know.
Perhaps a question on the call.
Yeah.
See if it comes up. Coming up, we've got more earnings to get to as shares of Affirm are in focus following their latest results. Stick around, much more market domination over time. That's coming up. Affirm quarterly earnings crossed the wire. Let's get to those numbers now. So Q2 EPS 23 cents. The street was actually looking for a loss of 10 cents. So that's better than expected. Q2 revenue, 866 million, Julie, versus the 809.5 that analysts had penciled in there. Just looking through, it looks like Q3 gross merchandise volume, they're calling for between 8 to 8.3 billion. The street is at 8.15 billion. And Q4 GMV 9 to 9.3 billion. The street was closer to 9.17 billion. And stock popping hard in the after hours here. Seen, of course, is kind of the true proxy really for BNPL, buy now, pay later.
Yeah, and I'm looking at the shareholder letter from CEO Max Levchin, and he talked about the record-setting holiday shopping season helping them, and he also points out that they are 5 months away from the target date that they had originally set to be operating income positive. He said, quote, "It should be apparent to a casual observer that we are nearly there today, market zero." So they've gotten to that target sooner than they had thought. He says, "We did it by relentlessly optimizing our transaction costs and by carefully adjusting our pricing." And in my talks with the Affirm team over the years, that is something that they have talked a lot about, is pricing risk appropriately, and that's one of the things they say sets them apart.
On the call, thinking more about GMV growth, consumer credit trends. It'd be interesting what Max Levchin has to say about all that.
Yeah, and there are always questions, I think, too, for these BNPL guys about other services, add-on services that they're going to be offering. So that should be interesting as well. Well, shares of Amazon under pressure, which could mean declines for the broader market on Friday. It comes after Alphabet's earnings report spooked investors. Market concentration's been a theme on Wall Street with the dominance of the Magnificent Seven. Our next guest says good stocks have been ignored as a result. Joining me now, Brad Clapmeyer, Macquarie Large Cap Growth Team Senior Portfolio Manager. As a large cap growth guy, though, I mean, you want these guys to perform as well. They're sort of part of your bread and butter. And so I am curious what you make of this trend that seems to be the cloud revenue from these hyperscalers not meeting estimates.
Yeah, no, that's obviously a big topic you were mentioning, talking about Amazon. What are the key drivers? Obviously, a key driver of that story and of sentiment is cloud revenue. And what we've seen from Microsoft, and we also saw from Google, is just slight disappointments on the growth that these companies are presenting. But I note in the commentary, what they're basically saying is we're running as quick as we possibly can to build out our data centers and put equipment in them so we can meet the demand. We are unable to meet demand at this time. And so right now, it seems like the demand-supply balance is in favor of them increasing their CapEx as they're doing, but 12 months from now, that may be a different story. I think more than likely the market will give these companies a pass for the short term.
Brad, a broader question about the Mag 7 concentration. You say we love the idea of concentration, just not a big fan of forced concentration or blind concentration. What do you mean by that, Brad?
Yeah, so sure. I mean, we're all in favor of having big concentrated positions as bets in the portfolio. And, I think one of the things we want to dismiss is we're not against these mega cap companies. I think a lot of times we can say, wow, these companies are just too big. But keep in mind, a lot of these companies have earned their spots in these index. I mean, Microsoft is a $250 billion revenue company that grew 16% last year. They added $33 billion in revenue in 1 year. That's just wild. $74 billion in free cash flow. It's a beast. So they've earned their story. But what we don't like is with an index being forced into these large positions, all of a sudden we've been overrun with the major thematic at the top of the Russell 1000 growth. A lot of these names are attached to a single thematic. We're talking about it on this right now during this conversation. We're talking about what's important to Alphabet. It's the cloud revenue. What's important to Amazon? Cloud revenue. What's important to Apple is can Apple Intelligence generate a mobile phone replacement cycle? So we have an index that's highly concentrated, 55% of our benchmarks in these Mag 7 names. And in theory, they're all somewhat attached and dependent on a single thematic. So we just want investors to be aware not only of what they're holding in their portfolios. We want them to be concentrated, actively concentrated, use discretion on those. But we also want investors to be aware if they think then they're investing in a passive diversified ETF, they may be in the same situation where 55% of their passive diversified ETF is actually in these large positions. We just want people to go back and rethink that.
So, Brad, we started off by saying maybe there's some areas that are overlooked because there is this concentration. What are those areas? Where should people perhaps be looking as they're doing these assessments?
Yeah, I mean, we think it always starts with quality. So quality is our number one emphasis. This is the whole idea of business modes, all weather, pricing strength, not dependent on GDP or where the interest rate goes or where we end up with regard to tariffs. So we want to find those companies that have that durable moat, and that's how we invest. And where that is now is where we think we can find a lot of opportunity. Parts of the portfolio you're mentioning were services, financial services stocks were looking relatively strong. The non-rate trades within financials we think are important. This would be Intercontinental Exchange, S&P Global, even the payments companies, Visa and MasterCard are wonderful business models. I think it'd be interesting to be sniffing around healthcare now more so. Obviously, there's a lot of sentiment negativity about what's ahead for life sciences names and drug development. I think those are things that tend to go on regardless of just the sentiment. And there may be opportunity in those areas as well.
Brad, thanks so much for joining the show today. Appreciate it.
Yeah, anytime. Thank you.
All right, more earnings to get to now. Shares of Cloudflare and Fortinet soaring after both companies topped earnings estimate. Let's do Fortinet first, Julie. That looks like a strong report. Q4 adjusted EPS 74 versus 61. I see billings of $2 billion. The estimate was more like $1.96 billion. Turning to the full year, they're guiding adjusted EPS 241 to 247. Versus 245, and for 2025 revenue, they're calling for between $665 billion to $6.85 billion. The street was closer to $664 billion. This one had enjoyed a strong run. It was up about 55% already over the past 12 months. You can see us tacking on gains there. There were some analysts I know who were covering them who thought, they actually look at Checkpoint's strong product results, and they were telling their clients they actually thought that boded well for this name, and they were right. Look at that, 8%.
Yeah, and let's also talk about Cloudflare. Similar story here. Similar industry, I should say, in terms of being within cybersecurity. That company's earnings beating by a penny a share, but the company's first quarter forecast is below what analysts have been estimating. But the share is not getting punished for it. They're up about 5% in after-hours trading. The company's 2025 forecast for adjusted earnings per share is also below what analysts are estimating. So kind of interesting here. This is a little bit different. Fourth quarter revenue also beat estimates, so bottom line and top line ahead of estimates at almost $460 million. So it's a little bit curious, I have to say, that we are seeing the forecast here below estimates, but the shares are higher.
And by the way, that stock was another one that had just roared into that print. It was up about 75% over the past year, but you are tacking on about 2.5% after hours.
Interesting.
Time now for What to Watch. Friday, February 7th, sponsored by Tasty Trade. Starting off on the labor market, we'll be getting January's full job report in the morning. Economists forecasting 175,000 non-farm payroll jobs to be added, while unemployment and hourly wages hold steady at 4.1% and 0.3% respectively. Jobs report will also provide a clearer look at recent job gains. A revision to U.S. job growth will be coming out in the morning with that report that will have revisions for the 12 months through the last March.
Taking a look at the Fed, we'll be getting some more Fed commentary from Fed Governor Michelle Bowman in the morning. This comes after comments yesterday from Chicago Fed President Austin Goolsbee. He warned of the potential inflationary impact of tariffs.
And moving over to the economy, fresh consumer sentiment data is coming out in the morning. Economists expecting that number to tick up slightly compared to last month to 71.8.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends. We're going to be diving into a mixed day for markets. The Dow closing lower with the Nasdaq and the S&P both finishing the day near session highs. We're going to dive into the rest of today's market trends. Then retail investing has never been more popular, and there have never been more ways for investors to get involved. So where are retail investors looking, and what are they most worried about at this point? We're going to get answers to those questions in just a minute. Plus, does the arrival of China's DeepSeek have companies rethinking their massive investments in AI? We're going to break down some of the big themes we're seeing in big tech earnings. Well, tariffs, inflation, trade wars, those are just some of the worries that are top of mind for investors right now. And joining me now is Caleb Silver, editor-in-chief of Investopedia. Caleb, always great to see you on set.
Great to be here.
So investors, you got a lot going on. You got tariffs, you got earnings, we've got DeepSeek. You have unique line of sight into how investors are actually taking all this in. So how are they feeling right now? Are they optimistic? Are they getting more cautious? What's the vibe?
Yeah, I think they're curbing their enthusiasm a little bit, especially post-election, especially over the past few weeks. You talked about some of those worries. Well, we see what our investors are searching for, but we also survey them every 2 months to talk about how are you feeling? Bullish, bearish? Where do you see the opportunity? Where do you see the risk? What are you most worried about right now? What would you do with an extra 10 grand? Always a fascinating question.
Yeah.
And right now that wall of worry is super high. And right at the top of the list is tariffs because of the uncertainty. And tariffs mean relations with China are going to be stretched a little bit. That's their number 2 or 3 concern. Inflation, obviously, in that group as well. But they're also concerned about these technological developments in AI that may make that pricing mechanism that has driven stocks like NVIDIA and others to these highs, and all the money being spent by these big tech companies. That's worrying them, the disruptiveness. But we also found this time they're a little bit concerned about deep fakes and misinformation, and they're concerned about potentially having misinformation, again, by AI derail their portfolioos.
Of all those worries, did valuation come up at all? Because we have strategists come on the show. I don't hear strategists saying, Caleb, you're a longtime market watcher too. I don't hear strategists saying, listen, I look at the market and I think we're, nosebleed levels. I do hear strategists come on the show and say, I think we're kind of full here. Does that come up in the surveys?
Yeah, we asked them what they think is in a bubble. What asset classes are in a bubble? Top of that list, mega cap tech, for all the obvious reasons. We've seen huge price surges in the big mega cap techs, and that over-concentration in the Mag 7 or whatever group of stocks, that's bugging them a little bit. AI-related stocks also at the top of the bubble list, and cryptocurrency in third. And after that, there's a big drop-off to other areas where they feel like there's a bubble. The funny thing is, they say mega cap tech, and then when you ask them, what are your top 10 holdings? It's mega cap tech.
Well, that's why I always love this question you guys ask, which is, all right, you got your reasons for enthusiasm and you got your reasons for worry, but then I always like how you ask them, bottom line, what would you buy right now? What do you want to own?
Yeah.
What do they want? What is on their list?
Well, if we ask them this question all the time. If we gave you an extra 10 grand, or if you had an extra 10 grand to invest, where would you put it? And for a long time when there was market uncertainty, you saw ETFs because that's a diversified way to approach the market. But it's been individual stocks for a long time. And why has that been the case? Because they've seen the runs of these stocks, whether it's a MicroStrategy, a Carvana, an NVIDIA, a Supermicro. They've seen these big runs, and they know that individual stocks can go on these big runs way beyond what the market can do. They produce a lot of delta there. So they're looking into those. And we also asked them, what stocks would you buy and hold today and hold for the next 10 years?
What they say?
They look just like the stocks they hold today. NVIDIA, Apple, Microsoft, Amazon. So they like the home cooking. This is what their portfolios have compounded with incredibly over time. There it is. They own the ones that they're worried about. And I think a lot of us, individual investors who have been piling into index funds or big ETFs, also own these stocks. We're over-concentrated, but they have been the only big game in town to bet on, and I don't think people are worried about potentially going away from this strategy.
Do you think as they get more cautious, do you think maybe part of why they looked at some of those big tech names, you think at the Apples, think at the Microsofts, is because there's a certain defensive quality to them? They're thinking, okay, steady Eddie, steady leadership, rock solid balance sheets. Is that potentially part of what's going on too?
And they're a little bit dip-proof in a way, because what fund manager is going to let a 20% drop in an NVIDIA or an Apple go to waste? Everybody wants to buy in on that dip because these are kind of value stocks, even though they're growth tech stocks. They've become so big, so widely held. A lot of them kick out that dividend that they are afraid to move away from them, and they know that dips don't last very long in this stock market.
What about Trump? What are the questions there? What are they saying?
Yeah, well, we asked them what assets would do best, they thought, in the next 4 years of the Trump presidency, and stocks are at the top of that list. Number 2, cryptocurrency, and then a big
Crypto is not, I mean, listen, that's, we were talking off camera, that's probably not a shock that you would pick those two.
Not a shock. We got a crypto czar. There's executive orders on developing the crypto infrastructure here. They know what's going on. They see the Trump coin, the Melania coin. They know that digital assets are going to be hot, especially the ones that have proximity to Pennsylvania Avenue. Same way with stocks, right? The stocks that they like the big mega caps tech stocks, but look at the seating chart at the inauguration. You could kind of pick the portfolio based on who was sitting where and weight it that way. That would be a good ETF, by the way.
That's fantastic. I think that's a Caleb. You put that ETF together, you got buyers, Caleb. What about the Fed? What do they say there?
Well, about half approve of the way the Fed's been handling monetary policy. Not a lot of disapproval. A lot of people don't really care too much, but most of the people approve of it, and they do not want, and we asked this question specifically, do you want the president to have influence over interest rate decisions? Decidedly no. Over 65% said no, the Fed should remain independent. I think that's interesting. These are individual investors who put their own money to work, and they like things the way they are in terms of that independence.
You think Trump stays silent, just doesn't offer his opinions about what Jay Powell should do?
Yeah, no.
No.
I'm taking the over on that one.
Yeah, that's fair. Caleb, always great to see you and have you here. Thank you for joining us. U.S. stocks closing mixed with the S&P 500 and Nasdaq closing higher for 3 straight days. And Yahoo Finance's Josh Schaefer joins us now with the trading day takeaways. Josh.
Hey, Josh. Yeah, we're actually going to start with a key takeaway from before the trading day even started. So Treasury Secretary Scott Bessent speaking to Fox Business last night, he said that markets maybe misunderstood partially what President Trump was saying recently about interest rates, saying that it's not about the Fed. What they're actually watching, Josh, is the 10-year Treasury yield. And I found this particularly interesting in thinking about sort of how the administration is thinking about rates, also what that means for the market, right? So one interesting thing, we've been talking a lot about the 10-year here, right, to start the year. Remember how high we were? We'll go to a 1 month. We were up about 4.8, wondering if we get to 5. One theory, Josh, remember we've talked about these bond vigilantes, right? This group that comes in and they say, government spending is going to keep going up. They're going to have to issue more debt. Yields are going to rise because of that. Some people are saying maybe this is the administration's way of sort of fighting against bond vigilantes, saying, well, we're watching the 10-year. We don't want the 10-year to move higher, so we won't do certain things that could move up bond yields. Maybe that some sort of read through there to be sort of signaling to the market, we don't want the 10-year at 5% either, so don't be expecting it to go there.
Also, Bessent's comments to media about Elon Musk were interesting too, because that has become such a focus for investors as well. His role in Bessent saying, listen, I personally vetted the Treasury personnel working with Musk on this government efficiency thing. There's been no tinkering with the department's payment system, all as well.
Mr. Musk, Josh, a popular person to talk about, it seems like right now in terms of the White House. Interesting story with his stock going on as well, which I'm not going to pull up for us. But Tesla down about 25% over the last month at this point. So the stock's been trending pretty low. But our second trend that we're going to take a look at, labor market. We got the jobs report tomorrow. One thing, though, that I was writing about today and caught my eye, Josh, continuing jobless claims. So we talk a lot about weekly jobless claims, right? Those are newly unemployed people that come and file for new unemployment benefits. This chart is continuing claims. So this means I've been continuously unemployed and I keep applying for unemployment benefits. Interesting trend here, continuing to sort of move higher and sitting at a 3-year high. So what does this chart really tell us about the labor market? We've heard a lot of low hire, low fire, right? A lot of people, there's not a lot of movement. This is employees or potential employees, workers, staying unemployed longer. This is a chart that sort of shows us what it's like right there out in the labor market. Yes, we're talking about a solid labor market, but right now, people are struggling to find jobs. And another reason why, if we flip to our other chart here from more data that was out earlier this week, the hiring rate's low, right? The hiring rate, when you take a look over the long term, it's pretty much back to where it was about a decade ago. And so for the hiring rate to be that low, continuing claims to sit there, just shows, yes, the labor market's solid, but maybe ice is thinning a little bit and you sort of wonder where things head.
Beyond the report tomorrow, I'm also just interested how the labor market evolves over 2025. And when you read through the research, Josh, do economists feel like generally they can make a call like that confidently, or no, they have to wait for more clarity out of immigration policy from Washington?
Definitely out of immigration policy, right? Because if we lose a lot of people here in the US, that would affect your unemployment rate, right? So if you have less people in the labor market, then the amount that are employed could actually go, or unemployed could go up, right? It could tinker with some of those levels. Other thing, Josh, too, that we've been watching is just what happens with this inflation story. Remember, so much of the labor market has to do with how much money you and I go and spend, right? If we go and spend money at businesses, they employ people, et cetera. But if inflation stays high, or if tariffs were to move inflation higher, then there's concerns that maybe even that could weigh on the labor market as we start to see inflation take a larger toll on the US economy. So right now, it certainly seems like steady as we go for now, probably steady as we go for tomorrow's report. But I would put the labor market in the same camp as inflation at this point. Beyond a couple months, things look a little murky, and we don't really know yet.
All right, tomorrow morning. Big day. Thank you, Joshua. Stick around. Much more Asking for a Trend right on the other side. We're on the other side of Amazon earnings now. That means we have to bring back, of course, Yahoo Finance's very own tech editor, Dan Howley, with the Dan Howley takeaways. What do we know, Dan?
Yeah, Josh, I mean, obviously the big deal here being that guidance came in a lot lighter than expected for Q1. They're saying between 151 billion and 155 billion. Wall Street wanted 158, so way shy of the midpoint there on guidance. And then one of the other things to look at, you know, they were close on revenue, beat on earnings, but AWS revenue came in just a hair shy of expectations. So one of the other things to just look at here, I think one of the big questions that we're looking for is what capital expenditures are going to be for the year. They had said for 2024 it was 75 billion. Everybody else is raising. Does Amazon? How do you go higher than that? I mean, you could pay me $75 million, I'll build you a bunch of computers. They're not going to be good, but whatever. But yeah, I mean, just to find out what this looks like. Also, I just want to shout out the Mets and Pete Alonso coming back. That's
obviously. It goes without saying. Well, we should mention, listen, the stock, we were down a quick 7%.
Yeah.
We have there. We're down to about 2% now. Let me, a broader question for you, Dan Howley. So all the cloud giants, we got all the results now. We got Amazon, we got Alphabet, you got Microsoft. What have we learned about that cloud computing market so far? Where are we? Where are we headed?
They all missed. And it's hard. It's hard because like they missed, but like not. It's not so much of it. I mean, it's a couple of $100 million. What's that between friends? But it's a miss nonetheless. And I think one of the things that we want to know from Amazon on this call is what does that mean as far as supply and demand, right?
Yeah.
Are they capacity constrained like Microsoft and Alphabet are, which is what they said during their call, or is it something else? So I think that's the big question that is going to be on analysts' mind. I'm sure they're going to come out with that right out of the gate. It's not something that an analyst is going to have to ask for. But if it is, then I hope they do and we get a firm answer because at first there was the cloud shy for Microsoft, obviously did not do well after earnings. Same with Alphabet, Google, Amazon dealing with it here. Not as bad as Microsoft and Google were. I think they were off a lot more than the 2% that they're off right now. But it really comes down to what's going on with the cloud. Do they not have the capacity? And then, well, you don't got the capacity. How much more are you going to spend to get there? And I think those are the big things. And it's not just the capacity. It's also the balancing act of between AI and non-AI cloud services. That was something that Microsoft had pointed out was, we're just trying to balance all this. And then Google came out. Is it this? I don't even know when Google announced now. It was
feels like months ago, doesn't it?
Yeah, but they essentially said the same thing. So I think that's going to be the real big question for everyone on this call.
Dan Howley. Always appreciate the summary. Thank you, my friend. AI and CapEx spending has been at the center of big tech earnings for several quarters now, but the arrival of China's DeepSeek is making investors and companies alike reconsider just how much money needs to be spent to win the artificial intelligence race. And joining us now is Eric Makoya, author of The Transcript, founder, Mwango Capital. Eric, it's good to see you. So we just had Amazon report for these big tech earnings, AI efficiency, CapEx, those are front and center. I'm curious, as you read through the transcripts, how are executives talking about these trends, these dynamics?
Thank you for having me, Josh. Mostly for the earnings call so far, nothing much in the way of changes in terms of CapEx for the big tech because it happened pretty recently, so they're still trying to process it all. The big takeaway, of course, is that they have to be a bit more efficient in terms of capital allocation now, because what DeepSeek showed is that you can do a lot more with a lot less. So I think investors are asking them to cut down on CapEx. But I think the key takeaway, especially for which was key for Meta, was that yes, DeepSeek is out and about, and we want to compete with it, but we still need to put down as much CapEx as possible to be able to be at the front. And I think that's the key takeaway, that they're not scaling back on CapEx, at least not this year. So I think you've seen Microsoft promise $80 billion in terms of CapEx. You've had the previous speaker talk about Amazon putting up $75 billion, Google putting up $75 billion plus in terms of ramping up on CapEx. Similar trends and talk from around all the big tech companies. So from earnings calls, nothing so far in the sense of they don't want to cut down on CapEx. They want to ramp up on CapEx, mostly because they want to be winners, and the winner takes all. And that's the assumption from the various companies that we're handling in earnings calls so far.
You mentioned DeepSeek there, Eric. When you saw DeepSeek, when you read about their claims, this cheaper open source AI model out of China, to you, did that represent potentially some kind of real, meaningful, big inflection point?
Yes, it did. I think it was Mark Andreessen who said this is a Sputnik moment in AI. I think it was because a lot of investors took a while to process in terms of the implications. So what DeepSeek does, at least the innovation, is that they they enable the same kind of models to be created at cheaper rates. And I think that's what investors have woken up to, like, hey, we don't have to put in so much money into these models. If they're going to be commoditized, then we can put it in a bit less and still get as much power as before. So the forecast, at least on earnings calls, is that all companies, the big tech, they want to be a bit more efficient in terms of how they employ their capital going forward. I think the biggest takeaway would be when Nvidia reports and see if there've been implications in terms of scaling back of the orders that most of the other companies have put up with them. But so far, nothing so far to take away from in terms of AI and all this big tech investing in capex so far. So I think they're all ramping up and they're all in it to win it.
Spend. Eric, another big theme I would imagine on the calls, tariffs. How are you, when you're listening on these calls, the executives, how are they talking about tariffs and the potential risk there for their companies?
So I should say, coming into this year, there was a lot of optimism that was baked in after the Trump win. And I think that was clear across most of the companies that we're tracking, that they're very optimistic about the year. So I think there's a CEO who talked about there's been a meaningful shift in CEO confidence going into this year. But what happened is that confidence has ran into a bit of trouble in the past 2 weeks, especially as tariffs are being implemented. And definitely what you're seeing in companies are a little worried on the implications. Ford CEO was this week talking about if that 25% tariff is implemented, there'll definitely be a heavy hit in terms of profits. So I think what some of the companies have done in between the win for Trump and when he took off is that they've ramped up a bit on inventory. And that also has an implication in terms of pricing going forward. So I think a lot of companies are worried on how they're going to deal with that. But I think the key takeaway also for most of the companies is that they learned from what happened in 2016. They've been preparing for this moment, and now it was one of the scenarios that they envisaged. So they are preparing in terms of they've expanded their supply chains. They've made sure that they're more resilient than last time. So the hit may be huge, but it's not as significant as it was in 2016.
Yeah, so the CEOs are preparing. I think maybe a lot of investors are kind of wondering whether it's all one giant negotiating tactic. But Eric, final point here, M&A, you know the bet has been that it's going to be a friendlier regulatory environment, backdrop now with Trump 2.0. How do execs talk about M&A on these conference calls during this earnings season?
I should say, Josh, I've been surprised by how bullish investors have been. At least the CEOs generally across board have been about M&A going into this year. It feels like they were tired a lot in the past, given the past regime that was there. But now this regime kind of promises a lot of changes in terms of regulation and all. They're very excited to do more M&A this year. They're excited to bring those to bear. They're excited about fewer regulations. I think there's a lot of strong talk from earnings calls that they're really feeling liberated to do more M&A going forward. So I would bet on 2025 going forward being the year when M&A kind of ramps up from the couple of years that has been in the doldrums, so to speak. So I would be the sense is that CEOs are excited about the year ahead in terms of M&A, IPOs, and all that. So I would say they're bullish.
Yeah, we'll see how it shakes out, Eric. I can see how regulators, greenlight a lot of deals in energy, small tech, big tech. I don't know. We'll have to wait and see. Eric, great to have you on the show today. Appreciate your time and insight.
Thank you.
Coming up, Americans gearing up to chow down for the big game this Sunday, but it's going to come with big cost to their wallets. We're asking for a trend right on the other side. The big game is nearly here, with pizza and wings expected to be big winners among the viewers. Here to discuss how this all shakes out for the food industry is Yahoo Finance's Brooke DePalma. Brooke.
Good afternoon. While Americans are flocking, they're stocking up on those chicken wings and getting ready for the big game. And get this, they're expected to consume 1.47 billion chicken wings during the game on Sunday. That's according to the National Chicken Council. And consumers seem to be willing to pay up for it. As you can see right here, Wells Fargo telling Yahoo Finance that because there's such high demand, grocers are trying to strike that right balance between keeping the demand that they have while also filling that demand and seeing what people are willing to pay up for it. So that's increased price year over year of 7.2%. And Tyson's Food CEO told me that across pizza restaurants, local operators, as well as quick service restaurants, there is very strong demand right now for chicken wings and just protein in general.
Are there specific food chains that you look at and say, okay, these are positioned to win for the big game?
Two food chains you want to follow here. That's Domino's and Wingstop, of course, keeping with that chicken wing theme. But in addition to that, these are two stocks that many analysts in the street have been watching very closely. One, on Sunday, any delivery-centric business model is one that will do really well as consumers want to stay at home. But in addition to that, Wingstop is set to have another strong year. They are going to lapse a bit of tough comparisons compared to last year, where they saw same-store sales upwards of 20%. But with innovation and positive traffic, as well as this $16.99 meal deal bundle they have going on right now, Wall Street really likes that one. Domino's also considered a leader in pizza. We know that they have also tons of innovation like that New York style pizza, and Wall Street really liking it for that. Also, fun fact here, Domino's typically sells 2 million pizzas on the day of the Super Bowl. That's 40% more than a typical Sunday.
All right, so we hit wings, we hit pizza. What about, round it out, snacks, beverages, which brands?
You got to wash it all down, right? All right, so let's talk beer and let's talk beverages. For beer, Wall Street really likes Molson Coors here, and that's because the Super Bowl could be a good launching off point for them. We know that they gained share in recent years, and we don't really know exactly what's going to happen for tariffs here, but when it comes to tariffs, if Mexican beer prices go up, that could bode well for Molson Coors and Bud. You see also Mondelez Oreo cookies. They've been testing out different prices, different packages. They could bode well. We also know that there's lots of innovation around Oreo, so that could be good. And Coca-Cola, they continue to win over Mountain Dew and Pepsi. Yeah. And so that could bode well this Sunday as well.
Wings, pizza. I'm so
wings,
hungry,
we got beer, we got pizza, we got Oreos.
I'm starving. Thank you, Brooke. Appreciate it. All right, let's take a look at what's trending finally here after hours. Elf Beauty shares are sinking as it reports a miss on third quarter earnings. Company also slashing its profit and sales outlook for the full year, missing Wall Street's expectations. Elf Beauty citing softer than expected trends in January as a factor to lowering its outlook. And shares of Skechers slipping following their fourth quarter earnings results. That's despite exceeding estimates on the bottom line. The footwear company issued weaker than expected guidance for both the first quarter and for the full year sales estimates. And finally, take a look at shares of Expedia here. They're jumping after the company reporting better than expected gross bookings for the fourth quarter, showing continued strong travel demand. Both earnings and revenue coming in above estimates for the fourth quarter, and Expedia reinstating its dividend. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.